Alright guys, so here's part 2 of your video tutorial of revision questions. We're doing part C, which is based on revaluation of non-current assets. Now this question is based on revaluation of land. Okay, it says Jamson Limited purchased land in 1980 at a cost of 80,000. Land prices have increased significantly, and an independent appraisal at 1st of June 2019 valued land at 2.3 million. Okay, you're given the balance sheet of Jamson Limited before revaluation. So what you're asked to do is to prepare a summary revaluation journal at 1st of June 2019 to adjust land to its new value. Okay, so let's start. Now, in 1980, so if you take land, 1980, it was purchased at 80,000, and in 2019, the value of land went up to 2.3 million. So land prices increased by how much? It's 2.3 million minus 80,000. That gives you 2,220,000. And that is what we record as part of our revaluation journal. Okay, so how do we record this increment? What it is, you need to debit land at 2,220,000 and credit revaluation surplus, which is 2,220,000. Revaluation surplus is an equity account, so it is part of equity. All right, part 2. Prepare the balance sheet for Jamson Limited as at 1st of June 2019 after the revaluation. 1st of June 2019. Okay, let's prepare a balance sheet. All right, so land is recorded at its new value, which is 2.3 million. Business's capital did not change as they did not issue any shares. And you add an additional equity item to the balance sheet, which is revaluation surplus at 2,220,000. Okay, and that's it for part C of this question. All right, let's move on to the conceptual framework question, reporting entity. Now, this question is based on indicators of a reporting entity. Now, you're told that Glenn is a sole trader. He drives a small van, which he sells ice cream and drinks. Glenn paid $16,000 cash for the van, which is his only asset. He pays cash for everything else, including the purchase of ice cream and drinks. Glenn has a relatively small number of customers. He makes average sales of $40,000 per year and earns an average profit of $24,000 per year. All right, determine if the business above is a reporting entity. Stating the criteria, factors used, and your reasons. Also provide a conclusion. Okay, so let's look at the 3 criteria to classify a reporting entity. First, we look at separation of ownership and management. Okay, separation of ownership and management, which means whether Glenn runs his daily business operations or whether Glenn has hired a professional management to run his daily business operations. So Glenn is a sole trader, which means Glenn is the sole owner of the business. He's the one who manages the business by himself, which means there is no separation of ownership from management. Glenn is the owner and manager. Yep, that's part 1. Yep. So if Glenn manages the business by himself, if Glenn manages his daily operations from selling ice cream, drinks, to record keeping, then Glenn is the owner. He also runs his daily business affairs. Yep, which means there is no separation of ownership and management. For number 2, we look at whether the business is economically or politically important. As you can see, it's a small business, and it does not sell any items which are important for the economy. So, and Glenn has a small number of customers, which means Glenn is not employing large number of people. So Glenn is a small player in the industry. Glenn serves a small number of customers, which means Glenn's business is not economically and politically important. Okay, number 3, we look whether Glenn's business has sizable financial characteristics, whether Glenn's business has large investments, sales, and assets. As you can see, Glenn's business only makes average sales of $40,000 per year, which is on par with the salary, and profit is only $25,000. So Glenn does not make that much profit. Yep. So Glenn has no loans, no employees, only one asset, which is $16,000. So Glenn does not have sizable financial characteristics. I think Glenn's business does not have sizable financial characteristics, which means Glenn's business is not a reporting entity. It is not a reporting entity, and Glenn's business is not required to prepare general purpose financial reports in accordance with accounting standards. So we have here, there you go. So there are 2 conclusions. Well, Glenn's business is not a reporting entity, as it does not appear to meet any of the 3 criteria, and Glenn's business does not need to, or Glenn's business is not required to prepare general purpose financial reports in accordance with accounting standards. That's conclusion number 2. Thanks. All right, guys, so reporting entity part B is very similar. Well, very similar in a sense. You still use these 3 criteria. This is about Australian Rainbow Minerals, which is a global public company that is listed on the Australian Stock Exchange as well as overseas stock exchanges. It is one of the largest mining and resource companies in the world, employs over 100,000 staff, has billions of dollars. So this business appears to satisfy all 3 criteria which we listed in part A. Yeah. So Australian Rainbow Minerals Limited has clear separation of ownership and management, as in their shareholders do not run daily business operations. And this business is also economically and politically important, as it employs 100,000 staff, also has a number of suppliers and other businesses which are dependent on Australian Minerals Limited. So it's important for the economy, and Australian Minerals has sizable financial assets, loans, turnover, and profits. Yeah. So it appears to meet all 3 criteria, which means it is a reporting entity and it is required to prepare general purpose financial reports in accordance with accounting standards. All right, let's move on to the next question. So this question is on revenue. Okay, so you're given information about a country club which offers discounted bundle service packages, access to pint salon services. Okay, now what are the 3 service packages they offer? They offer access to spa and salon services, access to beach club and bistro, access to on-site tennis, which also includes a membership fee. All right, so customer L pays $40,000 upfront on 1st of July 2018. Orange Country Club determines that if it were to charge a separate fee for each service, if so separately, the fee will be as follows. Membership fee is $4,000, spa and salon services $20, beach and bistro $16, tennis courts $10. All right. So the reporting period ends at 30th of June. Okay. Prepare the journal entry to record this transaction in accordance with ASB 15 at 1st of July 2018 at the inception of the agreement. So when you get a question like this, what you need to do is you need to assign, let's see, so you have 4 services. You're given standalone selling prices. You record standalone selling prices. Yeah. Now let's work out the proportion of each service they offer. Now the total amount of these services is $50,000. What's the proportion of membership fee or the total service fees? Which is 8%. You divide 4,000 by 50. What about spa and salon services? It's 40%. What about beach club? 16,000 divided by 50 gives you 32. Tennis courts, 20%. That's 10 divided by 50. Yeah. So what you need to do is you need to assign the total amount paid by the customer, the bundle payment, which is 40,000. So you take 8% multiplied by 40 gives you 3,200. 40,000 times by 40% gives you 16,000. 40,000 times by 32% gives you 12,800. 40 divided by times by 20 gives you 8,000. Okay, when the business receives cash at 1st of June 2018, what you need to do is you debit cash at bank 40,000. At the inception of the contract, they can recognize this membership fee as revenue. It's $3,200 as revenue. So you credit membership fee revenue membership fee 3,200. And these services can only be recognized as revenue at the end of the year. So at the inception, these 3 services are not earned. They are recognized as unearned revenue. There you go. Yep. So by the end of 30th of June 2019, this country club is able to recognize these 3 unearned revenue as their service revenues. Okay, let's see. June 2019, you debit all these unearned revenue items and you credit service revenue. And that's about it. Alright guys, I'll meet you in the next video to discuss question number 4. Thanks.